Hey, this is Mike Swanson of Wall Street Window. I had a very good discussion today with Ike Iossif, who runs the website marketviews.tv. He's a good friend of mine, and we're talking together about what's going on in the financial markets. He shared me a couple of stocks showing the closest analogies to today's or this year's stock market price action with the past. And really, what this is about is our stock market expectations versus the reality of this year in the uncertain future. How do you deal with those things? And can we get a cloudy situation more navigable? What's the thing to think about here? Because a lot of people are trying to double up or double down on their positions to double up in their account because they lost like 20%, engaging in just increasing their risk. Is this the time to do that? Or is there other things to think about? What often depends on one situation, but I'm going to play the recording I had with Ike right now.
Hello, this is Mike Swanson. I'm here with Ike Iossif, runs the website marketviews.tv. How you doing today, Ike?
I'm doing well, Mike. Thank you.
Well, thank you for taking the time to talk with me and be willing to share our discussion today with my listeners and viewers because you sent me some really interesting charts that kind of are the things that are on my mind about this market. You know, where is this thing going? Can we compare the action today with what we've seen in the past? Because it's quite an interesting year.
Yeah, it sure is. And we've still got another 4 months until the end of it.
Well, you have the title Expectations and Reality, and I was expecting a bear market in stocks, but I was also expecting gold to do well throughout the entire year, and it went up for 6 months or so, 5 months, and has been falling with the market since then. So that was my expectation and how it differed, and for one thing.
Well, right now, there are many cross currents that are affecting all markets, including gold. Now, from my point of view, I think when investors look at markets, they need to put things into context. For me, putting things into context, it also means to take into consideration our own personal situation, okay? Now, if you're 40 years old and you are investing for your retirement, which is 20, 25 years away, then you're in a different situation, a different position from someone who is 60, 65 right now, and retirement is 2 to 5 years away. My subscribers, my listeners, on average, right now, they're between 55 to 65 years old. I'm in the same bracket as well. So, I'm looking at the market through the lenses of a person who is very close to retirement, at retirement, or has already retired. Therefore, the primary concern is capital preservation. Swing trading, short-term gains are secondary, okay? Right now, we're in a situation where there's lots of noise. And if you look at the fundamentals, you look at the technicals, you look at the price, you can find pretty much enough elements to support your point of view if you have a biased point of view. If you go down the list of negatives, you're going to find just as many positives. The yield curve is inverted, fine. You look at the strong labor market. 2 quarters of negative GDP growth, fine. It was just an inventory drawdown. Gas prices, falling because of lack of demand. Oh, that's great. That's savings for the consumer to spend more money elsewhere. Okay? So, if you have a biased point of view, you can find something to support your view. The key thing is not to have a biased point of view. And you can see the first chart. you can look at the current market and you can say, oh, until now, it looks very similar to 1962 or 2015. If you have a negative bias, you can look at it and say, well, that looks to me like 2008 and 1973. To me, the key thing is to realize that the outcomes are widely different. And therefore, that is where risk lies. So, as I said, if you're between 55 and 65, and your primary concern is capital preservation, what you need to take into consideration is not whether, oh, this is like 1962, so the money is going to go up, or, oh, this is like 2008, so we're going straight down. No, it's take both scenarios into consideration, look at your own situation, and make the appropriate adjustments. Now, in the last 52 years that I have been a student of the market, you may say, the single most important lesson that I have learned is to pay attention to whether the fundamentals, the internals, the technicals, and price behavior are all in sync. When all three are in sync, market risk is low.
Well, last year, that's why last year the internals of the market peaked out in the first quarter and declined throughout the entire year. And so there's plenty of foreshadowing that a bear market, or at least a big correction, was coming. That's why it's so important to follow these things. And we've done many interviews about your money flow indicators too.
Yeah, right now, Mike, what really has my attention is the divergence between investors' expectations and reality. And a good example of it is the euro-dollar futures. Now, the euro-dollar futures are interest rate-based financial futures contracts that are specific to the euro-dollar. Now, the euro-dollar, for those who don't know what it is, it's not something that has to do with the euro and the dollar. It's simply a US dollar on deposit in commercial banks outside the United States. Now, the fact that the euro-dollar market is relatively free of regulation means that the deposit can pay higher interest. The euro-dollar curve is an interest rate curve and one of the world's most widely traded futures. Deposits from overnight out to a week are priced based on the Fed funds rate. So what the euro-dollar rate says, so theoretically, the euro-dollar rate and the Fed funds rate should be the same, okay? If you look at the chart, we can see this. The Fed is saying that they will increase rates to about 3.5%, 3.8%, and they will keep rates at that level. But the euro-dollar futures imply that investors are expecting the Fed will cut rates starting in 2023, and they will reduce rates down to 2.8. That doesn't make sense.
Well, I mean, it would almost take a depression, I would think, for them to lower rates to 2.8% when there's so much inflation. I mean, how much? I mean, sure, inflation would go down, but still, I mean, it seems like a different world than we're living in now.
Well, the point I'm focusing is this, Mike. What is the single most known phrase in the markets? Do not fight the Fed, correct?
Mm-hmm.
Well, what does this chart tell you? Right now, investors are fighting the Fed.
Yeah, the Fed's not.
So two things will happen. Either the Fed is right or investors are right. But both can be right at the same time. These two outcomes are mutually exclusive.
Well, I was telling you before we started recording that so in May, there are multiple interviews by different Fed officials basically saying they don't want to lower rates next year unless they don't just because they want to make sure inflation goes down. They want to basically hold off the next rate cut for as long as they can, is really what they're implying. And market people don't seem to believe it. This euro dollar doesn't believe it, and people on TV that I've seen and else, just financial commentators in general, don't seem to believe it.
And there's a good reason for it. The Fed has lost credibility.
Well, I mean, I've seen just people, traders, stock market traders on Twitter, some of whom I known over the past couple months, perhaps, since the market started falling even, they were basically, they'd be looking for bottoms and predicting the Fed pivoting. I mean, even back in March, some people I know are saying this, oh, the Fed will be cutting rates before the end of the year, just because they'd seen the stock market go down. And that's what they had done. That's our experience. I've been trading since the 90s. That's been my experience. All these people's experience. The market fell 20%, the S&P in 2018, they lowered rates and it went up. 2016, it fell similar. They lowered rates, it went up. In 2012, 2011, there were 10% corrections, QE programs, and the market went up. So every time the market has just corrected, they've done things. I guess that's what people are simply, believe will happen.
Well, look, in my view, and again, is the view of a person between 55 and 65, it seems that the traditional notion of markets, fearing and following the Fed has given way to ignoring it. And having a Fed that is the least credible Fed since the 70s, to me, if you are near retirement, it's a very good reason to be defensive. Now, let's talk about the third chart, okay? We know from past history, the last 100 years, okay, on average, the S&P has stopped about 6 months before a recession and bottomed about 3 months before it ended. Well, how does this historical precedent compare with the market action of the last 8 months? All right? The S&P topped in January, implying that recession should start around June, 6 months later. And if we accept that the market bottomed in June, that implies the recession will end by September. In other words, the market's action the last 8 months implies that it has discounted recession starting in June and ending in September. Does that make any sense?
No, it makes no sense to me.
Sense?
Well, one of the things I've been following and check periodically are the futures contracts for real estate in the United States. And when I first started paying more attention to that, perhaps it was March, but at that time they were projecting that real estate prices would have a decline starting around now into the first quarter next year. Now, and real estate prices actually in the United States have softened since May. They're not crashing or anything, but they are down nationally a little bit, slightly. But now these futures contracts are projecting that the prices will decline 13% and bottom out at the end of next year. But even if it was in the first quarter next year, it's still not 3 months from now, right? It's too early it's just too early for this to be a recessionary trough, as you are saying.
Well, let's take a look at the next chart, which I must say it's from Kimball Charting Solutions, and they do pretty good work. You can find them on the internet. Now, notice that the bank's to S&P ratio has diverged negatively for the last 3 years. And if you go back 40 years, the last 2 times it diverged negatively for 2 years. the S&P ended up losing 50%. Of course, this time could be different. As a person near retirement, I wouldn't want to bet on it with my money.
Well, banks, I've been thinking that the 1970s would be a model for what we're going to experience. And it's not quite matching everything in the 70s, but bank stocks were among the worst performing sectors in the 1970s, even though because of inflation, they were actually making more money. Their earnings were growing, but the problem was their holdings in bonds, because banks put their money in bonds, that's what they deposit their money into. Those bonds are going down because there was a big bond bear market. And that's one thing that scares me about the bank stocks is bonds have been falling, and interest rates went to 0 2 years ago. So I think that's a secular low. Bonds trade opposite to that, and I think I'm scared of to be a long-term investor in bank stocks, frankly.
Well, let's take a look at the next chart. Okay,
Right.
That's from Dr. John Hausman. And what we see here, okay, is the current level of corporate profit margins. Right now, they are at the highest they have been ever. So what I'm saying is this. Let's say that we don't have a recession. Let's say we have a soft landing.
Mm-hmm.
The question is, how realistic is it to expect corporate profit margins to remain that high forever and become the new norm? You don't have to have a recession to have a reduction in corporate profit margins. Given where they are right now, they are the highest level they have ever been. So when you put it all together, okay, right now the market, or investors, I should say, are making about 4 or 5 assumptions, which to me seem unrealistic. The first assumption is that inflation is indeed transitory. The second assumption is that the Fed will realize this in time, and not only they're going to stop raising rates, but they will become cutting them. They will start cutting them in 2023. Third assumption is that the jobs market will cool enough to slow wage rises, but not to the point that it will negatively impact household spending. And lastly, consumer spending will rise in real terms, and corporate profit margins will remain at the current level forever. Now, if you're making these 6 assumptions, which is what the price implication is, I think if you try to put together an equation, a probability, you will find that it is rather improbable for all 6 to happen. So, the bottom line for me is this. Wall Street likes you to believe that the market is a discounting mechanism. It is always forward-looking. After 32 years of studying the markets, I'm convinced that the market is not forward-looking. It never is. It is a coincident indicator of current sentiment, wildly wrong at major turns. If the market was forward-looking, can somebody tell me what it was looking forward to at the November 2007 peak, at the 1929 peak, at the 1933 bottom, at the 2009 bottom, or any other top or bottom for that matter, okay? So, this thing about all the market, has discounted what's going to happen, it's just BS. It's a fairy tale, that is, advertised by Wall Street, but it's not the reality. For me, if someone is right now, near retirement, at retirement, or they have retired already, given the uncertainty on all fronts, the best posture is to be defensive. How defensive? Well, that depends on somebody's individual situation. I can't tell you. You got to look at your own, you know, economic situation and decide. Nevertheless, the bottom line is there are too many moving parts right now to be highly certain about anything. And therefore, if you're 35, if you're 40, if you're 45 years old, you can take the risk and you can wait 10, 15 years to find out. But if you're 60 or 65, probably you can't. That's my bottom line.
Well, I don't like losing money myself, so I don't feel like taking big risks in such an uncertain situation. I'd rather wait 6 months, when there's a more clear picture of what's going on than just throw my money at it right now. I feel like that'd be like, I might as well just put my money in a slot machine.
Well, yeah, and perhaps you're going to have more fun.
You get free drinks.
Yeah.
Well, one thought I had while you're talking is, and this goes for both people bearish and bullish on the market, is when the market crashed in 2020, it came back so quickly, and and then it fell so quickly and came back so quickly, and we've seen the market kind of trade like that. Like I mentioned, 2018, it fell 20% in about 3 months. Those flash crashes, the 2008 crash, the market would fall quickly and come back quickly. And I know people that the people that are bullish, these are kind of like traders that I've seen this year, they were I got the feeling they're trying to buy a bottom in expectation that we would suddenly be heading back up to the highs. At the same time, many people who I know that are bearish on the market have been looking for very sudden collapses and calling, a fall crash, for example. Myself, when the market started down in July, I thought we would see a 20% decline, but it took longer than I thought. I thought it'd fall 20% or something, then have a bear market rally and roll over. But I thought that the bottom would maybe, I thought it would be in March, and I think that's one of the things going on this year is that I think it's a bear market, but regardless, I think it's a very slow market. Yeah, it's not as volatile as it's been in a very long time, and it had a lot of low volatility up until 2020 for about 10 years, but that was during a bull market. So this is a very unusual market. I mean, if it's a bear market, I don't think any of us have ever been in a bear market like it.
Well, every bear market is bearish in its own way. And that serves the purpose to confuse you.
Yeah. And make people lose as much money as they can. It's a hard, difficult market. Yeah. Just 3 weeks ago, I saw an article in the Wall Street Journal saying that most American investors, E-Trade accounts, Ameritrade accounts, and whatnot, someone analyzed thousands of accounts. They're down 20%, and this was when the market had, already rallied for 6 weeks or something, and they're still down, much more than the market. So it's been a tough year for people. There's no doubt about it.
Joe Granville, the late Joe Granville, once told me this: you're in a true bear market when both bulls and bears lose money.
Well, I think he's right. I think this year's showing that's true. At least it's what's been happening so far. Well, as we wrap up, could you tell people where to go to get more information from you and what you provide people?
They can go to marketviews.tv, and I do my own research, which I publish weekly and monthly. And at the same time, I also post interviews with about 22, 23 colleagues like yourself in order to give my subscribers a better view by listening also to, but making them aware of other people's research as well.
Yeah, and I've been following your work and listening to interviews for over 20 years now. So I highly recommend people sign up.
Thank you, Mike.
Thank you.